What if you could build a $1 million portfolio with just 4 funds? No picking individual stocks, no messing with options, and definitely no guessing which crypto is going to the moon. Well, not only is it possible, it's exactly what some of the smartest, most successful long-term investors actually do. Most people think you need to be a Wall Street wizard to get rich. They're wrong. They get trapped in analysis paralysis, staring at thousands of options until they're totally overwhelmed, and so they do nothing at all, wasting their single most valuable asset, time. In this video, I'm showing you the exact 4-fund lazy portfolio designed to build serious wealth. I'll break down every single fund so you know exactly what you're buying, why you're buying it, and how it all fits together to change your financial life. The foundation. Why index funds are a cheat code. Before we get to the 4 funds, you need to get your head around the simple, powerful engine that makes this whole thing work. The index fund. Think of the stock market as a giant supermarket. Picking individual stocks is like running around trying to guess which single brand of soda is going to be a bestseller next year. It's almost impossible, and even the pros get it wrong most of the time. In fact, studies consistently show that over 10 to 20 years, somewhere between 85 to 93% of professional fund managers fail to beat the market. They fail because their fees are high and because picking winners consistently is just that hard. An index fund flips that script. Instead of trying to find the one-hit product, you buy a piece of the entire store. You own the whole supermarket. This is called passive investing. You're not trying to beat the market. You are the market. This is the exact strategy legendary investor Warren Buffett has championed for most people. He famously made a bet that a simple S&P 500 index fund would crush a hand-picked portfolio of hedge funds over 10 years. And he won. By a landslide. His logic is simple. Keep your costs low, stay diversified, and let the economy do the heavy lifting for you. When you mix that with the magic of compound interest, the results are just staggering. Let's say you invest just $500 a month. Over 30 years, with a 10% average annual return, the historical average for the S&P 500, that $180,000 you put in could grow to over $1.1 million. You don't need a crazy high salary to become a millionaire. You just need a plan and the discipline to stick with it. This is that plan. The 4 funds that make millionaires. All right, let's build this thing. We're using 4 specific ETFs, or exchange-traded funds, which are basically index funds that you can buy and sell like a stock. Each one has a job, a solid foundation, a momentum-driven powerhouse, a growth accelerator, and a laser-focused bet on the future. Fund number 1, the foundation. Vanguard S&P 500 ETF, VOO. First up, the bedrock of our portfolio. This is your core, your anchor. For this, we're using the Vanguard S&P 500 ETF, ticker symbol VOO. When you buy VOO, you own a small piece of the 500 biggest, most important companies in America. Think Apple, Microsoft, Amazon, the whole crew. It gives you instant diversification across every major part of the US economy. And the best part? It's ridiculously cheap. VOO has an expense ratio of just 0.03%. That means for every $10,000 you invest, you're paying a measly $3 a year in fees. Keeping costs this low means more of your money is working for you, not for some fund manager. VOO is the definition of set it and forget it. Fund number 2, the Momentum Engine. Invesco S&P 500 Momentum, ETF SPMO now for our secret weapon. This is what gives the portfolio a smart, dynamic edge. The Invesco S&P 500 Momentum ETF, ticker SPMO. SPMO doesn't just buy all 500 stocks. It scans them and invests in the top 100 with the strongest upward price momentum, the stocks that are already winning. Then it rebalances a couple of times a year, kicking out the losers and bringing in the new leaders. It automatically leans into what's working in the market, holding companies like Meta, Nvidia, and Broadcom when they're on a roll. Here's why this is so cool. It's a strategic blend of offense and defense. Its strategy of focusing on market leaders can offer a different risk profile than the broader market. And over the last decade, this approach has delivered powerful average annual returns, pushing upwards of 18%. With an expense ratio of just 0.13%, you're getting a dynamic strategy for a passive price. Fund number 3, the Growth Accelerator, Invesco NASDAQ 100 ETF QQQM. Third, we want to pour some gas on the fire, and there's no better place to find high-octane growth than the NASDAQ. For this, we use the Invesco NASDAQ 100 ETF, ticker QQQM. This fund tracks the 100 largest non-financial companies on the NASDAQ. Think of it as the all-star team of innovation. This is where you find the game changers in tech, healthcare, and consumer goods. You've probably heard of its famous older sibling, QQQ. Well, QQQM tracks the exact same index, but it's built for buy and hold investors because it has a lower expense ratio, 0.15% versus QQQ's 0.20%. That tiny difference saves you thousands over time. This index has been a powerhouse, delivering average returns of over 19% per year for the last 10 years. QQQM is here to turbocharge our growth. Fund number 4, the sector bet, VanEck Semiconductor ETF, SMH. Last but not least, we're making one concentrated bet on what is arguably the most important industry of our lifetime, semiconductors. We'll use the VanEck Semiconductor ETF, ticker SMH. Chips are the brains behind everything. Our phones, our cars, data centers, and especially the entire artificial intelligence revolution. It's a direct investment in the hardware that is literally building the future. SMH gives you exposure to the 25 biggest players in the semiconductor space, like NVIDIA, Taiwan Semiconductor, and Broadcom. Because it's more concentrated, it's going to be more volatile, no doubt, but with that risk comes explosive potential. The 0.35% expense ratio is higher than our other funds, but it's the price we pay for such a targeted shot at a world-changing industry. The blueprint, how to build the portfolio. Okay, knowing the funds is half the job. Now you need the blueprint. Your asset allocation is what brings it all together, and it should change a bit depending on your age. For the aggressive accumulator, 20s and 30s. If you're young, you have time on your side, so you can crank up the risk for higher potential returns. 40% VOO, the foundation, 20% SPMO, the momentum engine, 20% QQQM, the growth accelerator, 20% SMH, the future bet. This mix is unapologetically tilted towards growth and tech. You've got 40% in that stable VOO core. For the balanced planner, 40s and 50s, getting closer to your goal, it's time to start protecting what you've built while still shooting for growth. 50% VOO, a bigger, safer foundation. 20% SPMO, still riding the winners. 15% QQQM, easing off the accelerator. 15% SMH, a slightly smaller bet on the future. Here we beef up our allocation to the stable S and P 500, giving us a bigger cushion while still keeping a solid 30% in our high-growth plays. And here's a pro tip. You can buy all these ETFs on any brokerage. But if you're a mutual fund person, you can get a nearly identical S&P 500 fund at your brokerage. If you're getting value out of this, do me a quick favor and hit that like button. It tells the algorithm this is good stuff and helps other people find it. It takes 2 seconds and makes a huge difference. Thanks a ton. Putting it all into action. You probably have a few questions. Isn't there a ton of tech overlap here? Yep, and that's on purpose. This is a tech-forward, US-focused, aggressive growth portfolio. We are intentionally leaning into the sectors that have historically driven massive returns. What about international stocks or bonds? For this particular strategy, we're leaving them out. Why? The big US companies in VOO and QQQM are already global giants earning money all over the world. And as for bonds, they're for preserving your money. This portfolio is for growing it. You can worry about adding bonds later as you get much closer to retirement. The most important step is simply to start. Open a Roth IRA or brokerage account this week. Choose the 4 funds with the allocation for your age. Then, and this is the absolute key, set up automatic transfers for every single month. Rain or shine. That's it. That's the entire strategy. You don't get rich overnight. You don't get rich trying to time the market. You get rich slowly, consistently, and simply. This 4-fund portfolio does exactly that. It gives you a stable core, then adds layers of dynamic growth that tap into the biggest trends in our economy. So let this simple plan do the work for you. Let compound interest do its thing. The simple choice you make today is the one your future self will be thanking you for. If this video helped clear things up for you, make sure you subscribe for more simple, powerful wealth-building strategies. And hit that like button if you haven't already. Thanks for watching.